This is Macro Horizons, episode 380, Fed Independence Day, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of June 29th. With the 4th of July weekend quickly approaching, we'll observe that in the wake of Warsh's debut as FOMC chair, perhaps investors should consider June 17th as Fed Independence Day. Just a thought. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, economic data was limited, although we did receive the core PCE print for the month of May. Here we saw core PCE up 0.3%. That was in keeping with the market consensus, although there had been some rumblings that an upside surprise of 0.4 was anticipated by some market participants. On an unrounded basis, the move was 0.32%, so a solid but not particularly high 0.3. As a result, the Treasury market rallied, with the front end of the curve outperforming. To be fair, rate hikes are still priced in, although not fully for the next meeting, but the front end of the curve benefited and the curve steepened on the margin. The bigger move of the week came as front-month WTI crude oil prices dropped back below $70 a barrel, and 10-year yields subsequently slipped back below 440. Now, we certainly took solace from this, given that we continue to hold a medium-term constructive outlook on the Treasury market and do anticipate that over the balance of the year, 10-year yields will drift back closer to 4%. More importantly, a pullback in energy prices back to the pre-war levels, which is precisely what we've now seen, implies that while there might be some upside risk for pass-through to core inflation from the energy shock over the next several months, we also have the reverse to deal with in the following several months, which we'll argue reinforces the prudence of the Fed remaining on hold for the foreseeable future, as opposed to chasing inflation with a rate hike or two. It's also not wasted on us that a fine-tuning rate hike or two isn't going to solve the fundamental problem of the energy shock. Instead, it will simply tighten financial conditions, put the equity market at risk, at least on the margin, and stall progress towards normalizing rates, which presumably is still on Warsh's agenda, even if it ultimately is accompanied by shrinking the balance sheet at some stage. The week just past also gave us the final revisions to Q1 real GDP. Business spending continues to be the story, but we saw the consumer or personal consumption disappoint, up just 0.5% for Q1. Compared to the 1.4% prior estimate, and well off of the initial print. This reinforces the notion that while the upper quartile might be continuing to drive consumption in aggregate, there are certainly plenty of headwinds for many households in the U.S., higher prices being an obvious one. And as we contemplate the next several months, the bigger question then becomes whether or not a pullback in gasoline and presumably food prices will help the consumer. It certainly will in real terms, as household purchasing power will increase in an environment of lower headline inflation. As with the shift in headline inflation more broadly, this reinforces our outlook for the Fed to remain on hold, at least over the summer months.
Ahead of the core PCE figures, it was a week that was dominated by the follow-through to the reopening of the Strait of Hormuz and a return to some version of normal traffic of oil through the critical waterway for the global energy complex. What this translated to in terms of the price action was oil dropping back to pre-conflict levels and the lowest price in crude we've seen since late February, which in bond market terms translated through to an impressive round of bullishness on Wednesday specifically that resulted in 10-year yields dropping below 440 as the more severe inflationary concerns resulting from the war in Iran are in the process of being undone. This dynamic was also extremely apparent in the tips market, with front-end break-evens collapsing as well, with some benefit of a positional tailwind there as well. But for the time being, now that oil is once again leaving the Persian Gulf and crude prices are back to within striking distance of where they were earlier this year, investors have returned to focusing on the state of the domestic economy and what a Warsh Fed means for the path of policy rates, which has kept the yield curve under a significant amount of flattening pressure, with 2s10s back down to effectively 25 basis points.
In other interesting technical milestones achieved, the 10-year yield did dip below 440, and we're now focused on an opening gap that's at roughly 435. Through there's very little resistance of relevance until we get to 425, with the 200-day moving average at roughly 420 below there. At its essence, what we're seeing is an unwind of the price action that defined the conflict in the Middle East. And frankly, the logic is relatively straightforward. We have spent the last 3.5-4 months trading the forward inflationary implications from higher energy prices. Now, with crude oil effectively back to pre-war levels, the market is left to contemplate the pass-through of lower energy prices through to core goods. Now, there is a timing mismatch that will leave the Fed in a very precarious situation. Specifically, it takes several months of elevated energy prices to flow through to the core CPI and core PCE series. So what we've seen at the start of this year won't manifest in the data until the second half. But at the same time, what we're going to see in the second half, i.e. lower energy prices, should take a comparable amount of time to be evident in the realized data as well. Assuming such a timeline, patience is the most prudent approach for the FOMC. This is somewhat at odds with what the market is pricing in, however, and we see a full rate hike still priced in through the October meeting, and the 2-year sector has rates well above 4%. This has contributed to the flattening bias, to be sure, and as we consider the degree to which break-even rates can fall from here, it's difficult to attempt to fade the flattening bias. We've been focused on the 2025 low mark for the 2s10s curve, which is 15.9 basis points, as our objective over the course of the next several weeks. And the recent price action has done nothing but reinforce that bias for the time being.
And there's also what we've seen in terms of the equity market moves and the fact that the exuberance that pushed the S&P 500 to fairly consistently setting new all-time highs has come off, at least on the margin. And while it's hardly a volatility event that reaches the threshold to justify any reaction from the Fed, given the tightening aspirations from a financial conditions perspective that Warsh is attempting to pursue in order to ensure that inflation doesn't pick back up, the fact that we're not seeing what at one point was a perpetual easing of financial conditions is surely a welcome development. To say nothing of the fact that this has come along with an increase in 2-year yields that hasn't translated to a commensurate pickup in 10-year yields, aka the flattening of the curve, and especially as we consider the administration and the Fed's worries about housing affordability and the impact that longer-dated Treasury yields have on mortgage rates, the dynamic we're seeing play out, which is a gradual, not disorderly, softening in risk asset performance, combined with a steady grind lower in longer-end Treasury yields, or at least not acceleration higher in Treasury yields, is precisely the outcome that we'll argue both Warsh and Bessent are pursuing at this point in the cycle. Now, what remains to be seen is whether the June payrolls report is strong enough to realistically introduce the potential of a rate hike in July, or if the operating assumption from the market's perspective is that the earliest we could see a potential hike would be in September. None of the data we've seen over the past several months, aside from maybe some pickup in credit card delinquencies, would suggest that the labor market is facing any meaningful amount of pressure, or consumption is at imminent risk of taking a significant step lower, and so our, and we'll argue the market's operating assumption, is that the June payrolls report will confirm that the labor market is still in a good place. However, that good place is not in and of itself sufficient to get the Fed to hike in July, particularly now that we have oil prices that are heading the right direction from the monetary policymakers' point of view. So moderating upside risks to inflation and a still solid labor market are really a strong incentive for the Fed to take the summer off.
And as the traditional logic goes, the Fed will cut rates because of the labor market, but hike rates because of inflation. And as long as we haven't seen a true shift of the Fed's reaction function to the incoming economic data in the form of pockets of sticky inflation, then an on-hold policy bias should be the path of least resistance. Of course, Warsh's effort to refocus the market away from the traditional marquee data releases, such as non-farm payrolls, offers an interesting wrinkle into how the market could trade the week ahead. We do have the ADP series, specifically the monthly figures for June, which, if nothing else, should set the tone and the backdrop for absorbing Thursday's figures. It's also a holiday-shortened week with an early close on Thursday and a full closure on Friday for the Independence Day holiday. The non-farm payrolls release at 8:30 on Thursday morning will most likely be absorbed by a market with limited participation and limited conviction. That doesn't mean that we won't see a traditional knee-jerk response to the combination of payrolls, the unemployment rate, and average hourly earnings, but rather we would fade any outsized reaction, whether it is a bearish or a bullish one, given the current market conditions. We will hear directly from Warsh on the morning of Wednesday, July 1st, and the market will continue the process of becoming familiar with Warsh as Fed chair and the amount of communications that he's willing or unwilling to provide investors in light of the rapidly developing geopolitical landscape combined with a U.S. economy that continues to be more resilient than one might have otherwise anticipated given the prevailing cross-currents of macro risks.
And there's also what we may or may not learn from the variety of task forces that Warsh has set out to address some of his priorities in terms of reforms at the Fed. And while it's not a foregone conclusion that we'll get any incremental information as work is done and studies are conducted on issues like the balance sheet and forward guidance, it's not unrealistic to anticipate that as the summer drags on, there could be articles or studies released from the Fed in an endeavor to lay the groundwork for the ultimate findings that we're assuming are going to be revealed sometime around Jackson Hole at the end of August. It's in this context as well that in contemplating the sequencing of the potential changes that may or may not be coming, that it strikes us as unlikely that enough time will have passed ahead of the July FOMC meeting for there to really be any concrete conclusions on any of the more durable changes that Warsh hopes to implement on the Fed. And so instead, our bias is that the June payrolls report will be taken under consideration, but likely not really be a game changer in terms of the state of the real economy, and that will effectively set up July as a very data-dependent trading environment, presumably with 10-year yields not so far from where they are currently, as investors trade NFP, wait for CPI, take down the Fed, and then look forward to Jackson Hole and the September FOMC. That is the earliest we would expect any real changes to be formally announced, either as it relates to the balance sheet or the level of Fed funds. But frankly, even September would be a very aggressive timeline in central banking world.
So what you're effectively saying is wake me up when September ends again?
Or starts. When's the meeting? Somewhere in the middle of the month.
It's interesting in this context to keep in mind that the bulk of the price action over the course of the last 3 months really has been directly tied to crude oil prices. Whether it's Brent or the front month WTI contract, we've, for all intents and purposes, traded tick for tick with energy costs, and we now find ourselves in an environment where the upside in oil has been unwound. And the question then becomes, are we going to stabilize at the current levels, in which case one should expect a comparable move in treasury rates, i.e. stabilizing with 10-year yields between 430 and 440, or is there further downside yet to be realized as the urgency to trade the conflict begins to ease over the summer months? it certainly isn't wasted on us that we're shifting into a period that has historically been constructive for the Treasury market, i.e., the summer months tend to be bond bullish from a seasonal perspective. While this certainly conforms with a de-emphasis of the upside inflation risks associated with higher energy prices, it's difficult to be particularly bullish on the 2-year sector unless and until there is further clarification from the Fed that the bar to hike in July and September is higher than the market is currently pricing.
I don't know. Just trading oil all summer sounds like a pretty slippery slope.
Well, it might spill over into other assets. In the week ahead, the Treasury market will have a shortened trading week, full trading sessions on Monday, Tuesday, and Wednesday, but an early close on Thursday, and Friday, July 3rd, the market will be closed for the Independence Day holiday. We do see the payrolls print on Thursday morning. Expectations are for the headline to increase 130,000 jobs with an unemployment rate of 4.3%, and average hourly earnings are seen up just 0.3%. One of the striking aspects of the recent bounce in jobs has been that it's been accompanied by a low overall labor market participation rate, but also relatively benign wage gains, which, from the perspective of monetary policymakers, implies that there's no evidence of a wage inflation spiral that could be building at the moment. The week ahead also includes the ADP figures for June. Here, the market is expecting 110,000, which is in keeping with headline payrolls estimates. Investors will also hear from Fed Chair Warsh on Wednesday morning. It will be interesting to see the degree to which he's willing to publicly speak without providing any monetary policy guidance beyond the relatively sparse wording of the recent FOMC statement. It will be an interesting setup for the long holiday weekend, to be sure, and taking a step back, we anticipate that trading conditions will be characterized by limited conviction, low volume, and a market that's willing to allow the price action to run simply under the assumption that we're shifting into the classic summer doldrums style trading environment for the next couple of months. Now, that being said, as long as the trajectory of energy prices remains lower, or more importantly, doesn't rebound back above $70 a barrel, then this creates an ideal environment for a consolidation in the Treasury market. Consolidation in this context implies a drift lower in 10 and 30-year yields as forward break-evens continue to compress, and the market has confidence not only that a Warsh Fed will be willing to step up and hike rates in the event that such a move is justified, but also that the upside to inflation created by the energy shock will spend the bulk of the summer unwinding instead of extending to the upside. As investors continue to grapple with a fuller understanding of the Warsh Fed's reaction function to inflation that's been seen thus far, incoming Fed commentary will be useful, but the degree to which Fed officials will be willing or able to provide the type of context and color that we saw under the Powell Fed is an open question, and we expect that it will take several weeks, if not months, before the market is fully convinced in either direction. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we look toward the 3.5-day trading week ahead of the 4th of July weekend, it strikes us that the BLS decision to release payrolls on Thursday morning isn't in keeping with the spirit of celebration. July 10th would have been just fine. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.